They tell you the economy is resilient, they point to the stock market highs, they point to corporate earnings, and they tell you that the debt is just a number. But what if I told you that the foundation is cracking? What if I told you that the debt bomb isn't coming, it has already started to tick, and the explosion is already underway? Welcome back to the channel. I'm Vicky. Today, we aren't talking about the news headlines that keep you sleeping at night. We're talking about the silent structural failure happening in the US financial system, an implosion that the smartest investors in the world are positioning themselves against right now. You see one cockroach, and you assume it's just one. But in the world of high finance, if you see one cockroach, you know there's a colony hidden in the walls. Today, we are going to expose where those cockroaches are, why the biggest funds on Wall Street are liquidating their positions, and more importantly, what you need to be doing to protect your capital while everyone else is still buying into the euphoria. This isn't a prediction, it's an analysis of what is happening in real time. As we saw in the latest movements, the US debt bomb has effectively imploded, creating ripples that every single investor needs to understand before they make their next move. To understand where we are, we have to understand the mechanics of the debt bomb. It's a term that gets thrown around, but few people actually look at the math. The US national debt isn't just a political talking point. It is a mathematical trap. When debt to GDP ratios reach the levels we are seeing today, you are no longer in a growth cycle. You are in a maintenance cycle. Every dollar the government spends today is borrowed. And with interest rates elevated compared to the last decade, the cost of servicing that debt has skyrocketed. We are in a situation where a massive percentage of tax revenue goes purely to interest payments. This is the definition of a debt bomb. But here is the detail most analysts miss. It's not just about the government. It's about the contagion. When sovereign debt becomes this expensive, it drains liquidity from the entire system. It's a vacuum. It pulls capital away from innovation, away from infrastructure, and into the black hole of debt service. Why does this matter to you? Because markets thrive on liquidity. When the government sucks the liquidity out of the system to pay its own interest, there is less money for the private sector to expand. That leads to stagnation, then to credit crunches, and eventually to the bankruptcy filings we've been tracking, like the subprime auto lenders, where executives were pledging the same collateral to multiple lenders just to keep the lights on. That is the behavior of a system that is starving for cash. And that, my friends, is exactly where the cracks begin to show. So, what are the smartest investors in the world actually doing about it? If you look at the moves being made by the legends, the managers who have successfully called every major bubble for the last 50 years, you see a pattern. They aren't buying the dip. They are exiting the game. We've seen it with Berkshire Hathaway. Warren Buffett is sitting on a record $397 billion in cash. Think about that for a second. That isn't just prudence. That is a war chest. That is a statement that says, I see nothing in the current market worth the risk of my capital. And it's not just Buffett. We are seeing major hedge fund managers liquidating massive stakes in the largest tech giants, Google, Amazon, slashing positions by 94% in a single quarter. Why would you sell a stake worth billions in companies that everyone considers too big to fail? Because these investors know that when a liquidity crisis hits, the first things to go are the blue chip assets that have become overvalued. They are selling into the euphoria because they know that history doesn't repeat itself, but it rhymes. And the rhyme here is a market collapse triggered by an inability to pay for the debt that fueled the growth. They are holding cash because cash provides optionality. When the market breaks, the person with the cash gets to decide the price of the recovery. That is the strategy of the elite. They are not waiting for the crash to start. They are preparing for the aftermath of the bomb that has already gone off. Now, let's talk about you. Let's talk about human psychology because it is brutal. People do not sell into euphoria, they buy into it. That is the paradox of market cycles. When the news is good, when the charts are green, when everyone on your social feed is talking about their latest returns, that is the moment the smart money starts selling. But retail investors, they see the trend, they feel the fear of missing out, and they buy. They buy because they believe the euphoria will last forever. They believe that the debt bomb is a myth, or that the government will always find a way to paper over the cracks. But you have to realize that market sentiment is a lagging indicator. By the time you feel confident enough to buy the dip, the liquidity has already drained, the institutional money has already moved to the sidelines. You are essentially left holding the bag of overvalued assets, while the people who created the trend have long since exited. This isn't to say you should panic. Panic is just as bad as blind euphoria. But you must distinguish between optimism and delusion. Optimism looks at the data, sees the risks, and prepares. Delusion ignores the data and hopes for a miracle. We are here to look at the data. We are here to look at the reality of a system that is currently repricing risk in real time. Consider the reality of the middle class and the broader American economy. We are seeing a shift where the cost of living is rising while the actual value of assets is becoming untethered from reality. We discussed previously how the American middle class is being squeezed, and this debt-driven environment is the catalyst for that squeeze. When the government chooses to inflate the currency to pay off debt, it is a hidden tax on everyone. It eats away at your purchasing power, and it forces you to take on more risk just to stay even. If you are an investor, you have to ask yourself if you are truly diversified or if you are just exposed to the same systemic risks that are currently imploding. The smartest investors are not just moving to cash. They are moving to assets that have intrinsic value, assets that do not rely on the grace of the Federal Reserve or the continuous issuance of more debt to sustain their value. They are looking for businesses that can survive a contraction, not businesses that require constant, low-interest funding to operate. Let's dig deeper into the specific mechanisms of this implosion. We are seeing a divergence between what the public sees and what the credit markets are signaling. You look at the stock market index and you see a steady line going up, but then you look at the credit default swap market or the yield curves on treasury bonds and you see flashing red lights. That divergence is the debt bomb in action. It is the widening gap between the perception of wealth and the reality of insolvency. The corporate debt market is particularly concerning. We are seeing companies that have been zombie firms, companies that generate just enough cash to pay interest on their debt, but never enough to pay down the principal, suddenly losing access to the capital markets. When the credit tightens, these companies collapse. They cannot refinance. They cannot borrow more. And as they collapse, they trigger a chain reaction that hits the banks, the lenders, and the broader supply chain. This is exactly what happened in the subprime auto lending market. It starts with one lender, then another, and then the realization dawns that the entire sector was built on shaky collateral. We are now seeing the potential for this to spread to commercial real estate, to tech, and eventually to the sovereign debt markets themselves. So what does this mean for your personal portfolio? It means you need to rethink your strategy. If you are holding assets that are highly leveraged companies with debt-to-equity ratios that would make a bank nervous, you are exposed. If you are holding speculative tech stocks that have had their valuations inflated by cheap money, you are exposed. You need to pivot toward quality. You need to focus on companies with clean balance sheets, companies that have enough cash on hand to weather a prolonged period of stagnant growth. And you need to look at the psychology of your own investing. Ask yourself, am I buying this because I have done the fundamental analysis, or am I buying this because the price has gone up and I don't want to be left behind? That feeling of needing to be in the market is exactly what the smart money feeds off of. They need you to be buying when they are ready to sell. They need your liquidity to provide the exit for their positions. Do not give it to them. The road ahead is not going to be easy. We are transitioning from an era of free money to an era of consequences. The debt that was used to fuel the last decade of growth must now be serviced, and the only way to service it in a stagnant economy is through drastic measures that will likely impact asset prices. This is not about fear-mongering. This is about being realistic. If you prepare, you have nothing to fear. If you ignore the signs, you are at the mercy of the market. The debt bomb is a structural issue, not a temporary glitch. It will take years to unwind, and there will be periods of volatility that will wipe out the unprepared, but there will also be opportunities. The investors who are sitting on cash, like the ones we've discussed, are not sitting on it because they are scared. They are sitting on it because they are patient. They're waiting for the moment when the market reprices assets to their actual value. When that time comes, the capital they have preserved will be worth significantly more, not just in nominal terms, but in purchasing power. Think about the lessons of the past. Every major financial crisis, from the dot-com bubble to the housing collapse, was preceded by a period of euphoria where people ignored the warning signs. They ignored the debt levels. They ignored the lack of liquidity. They ignored the deteriorating quality of assets. And in every instance, those who were able to see the reality of the situation and act accordingly were the ones who emerged on the other side with their wealth intact. You have the opportunity to be one of those people. You have the access to the data, you have the ability to analyze the trends, and you have the choice to act. Do not let the noise of the mainstream media or the excitement of the crowd distract you from the hard facts. The hard facts are that the system is leveraged, the debt is mounting, and the liquidity is drying up. That is the reality. We are entering a phase where the winners will be determined by their ability to hold on to what they have and their discipline to wait for the right moment to deploy capital. This is not a time for gambling. This is not a time for strategy. It is a time for looking at your investments and asking if they are truly built to last. It is a time for reducing your leverage and increasing your liquidity. It is a time for understanding the psychological traps that lead to poor decision making. We are in this together, and we are going to navigate this shift by keeping our eyes on the data and our emotions in check. The debt bomb is ticking, but that doesn't mean you have to be part of the collateral damage. You can choose to position yourself differently. You can choose to align yourself with the reality of the situation rather than the fantasy of the market. If you found this analysis useful, it's because we don't focus on the noise. We focus on the mechanics of the market, the stuff the mainstream media avoids because it isn't exciting enough. But the truth is rarely exciting. It's usually just hard to look at. We are building a community here for those who want to understand the system, not just survive it. If you're serious about protecting your wealth and understanding the macroeconomic forces that actually drive your portfolio, I want you to hit that subscribe button, and I want to hear from you. Look at your own portfolio. Are you holding companies that rely on cheap debt to survive, or are you holding businesses that are immune to interest rate hikes? Leave a comment below with your strategy. Let's have a real data-driven conversation. I'm Vicky. Stay sharp, watch the data, and I'll see you in the next one.